Welcome to the next video in the series. I said in the last video that I was going to talk about the Russell 2000, and I'm going to look at two areas of the Russell 2000, debt and earnings, and why they're so important going forward, not just as a measure of performance for fund managers, but as a measure of performance of the economy in general, and the risks that are inherent in the economy in general because of factors that are going on behind the scenes. Now, let me say, what is the Russell 2000? Well, it's part of the Russell 3000, and it's the bottom 2,000 shares of the index. And the capitalization of the shares ranges anywhere from between 300 million and 2 billion. So it's not an insignificant measure of the US economy as far as indexes and shares are concerned. Now, it's used basically as an indicator by small caps fund managers to measure performance. And I think this is erroneous, especially in today's market. And you'll see why as this video goes ahead. And it'll astound you what's actually happening in the companies within this index. Now, there are two really important factors: debt and earnings. And debt, because debt is one of those things, obviously, where if a company has too much debt and too much of the wrong debt, and it doesn't have the earnings to cover that debt, the company goes out of existence. It's a simple fact. So let's look at this particular graph here, and this is courtesy of Société Générale, SocGen, in other words, French bank, and they've done some analysis on net debt and EBITDA. EBITDA is earnings before income tax, depreciation, and amortization. So basically, it's the net results of a company's performance as far as profit's concerned. Now, what we can see is back in 2002, the amount of debt was, probably about 25-30 billion, and even that hadn't changed that much. It had more flatlined, and it was up a bit just during the crisis, as you can see, from 2007 and 8. But look at the growth from 2010; it's exponential, and the disparity between EBITDA and net debt is just absolutely incredible. It's exponential, and it's been widening. So what does this mean? This has several meanings, and we'll come back to this chart later on in this video. What it actually tells us is debt growth being exponential and it's steep, is the EBITDA is badly trailing it. So the EBITDA, the earnings, and therefore the productivity of that debt growth is not being reflected by that debt growth. And what it means is the marginal utility of that debt is decreasing dramatically. And yet, remember, we've got historically low interest rates. We haven't seen interest rates like this in generations. So if these companies can't perform in terms of productivity with this cheap money, we're certainly in a lot of problems to come. And part of this is that debt has replaced the incentive for CapEx. I mean, basically, cheap debt means that you can borrow the money to pay out as dividends instead of invest the money. And it makes the share more attractive to buy for investors. And that makes everybody happy because the share price goes up. Well, it makes everybody happy as far as the management's concerned, because the share price is going up, and it looks like the performance is going up, but it's not, as we'll see later. So why does this make me nervous? And it makes me very nervous. Is let's have another look. Let's have a look at this. We can see from this particular chart here that the blue line is earnings per share expectations, and it's up past 75%. But look at the blue line, percent of profitable firms, it's at 62% and 61%. Well, again, what does that mean? Well, it means that the amount of firms that are not making money is extremely high. Let's look at some facts. This is research done by a chap called Vincent Deluard from INTL FC Stone. And what it does, it states that 670 out of the 2,000 companies have been unprofitable, right? That's over a third, okay? And that's what represented 65% profitable, 33% or more unprofitable. So that chart is a mirror image of this research that's been done. Now, what this chap Deluard did as well is he actually measured that 408 companies have lost money over the past 16 quarters over the past 20. Think of it, that's a massive amount of loss that these companies have been making. Now, so we have 38% of these companies loss-making. Well, what's the big deal? The big deal is that the S&P, according to facet data, only 5% of their companies lose money. Yet this is versus 38% of companies in the Russell 2000. So this is misleading in my view in terms of what the strength of this index is as an indicator for investing into, and also the health of the US economy in general. So if we have a look at this, is really, really important to me, because a lot of investors look at PE ratios for the value aspect of investing in a particular share. What is the real value when we look at these? What is the real price to earnings ratio of these particular shares? And the result will probably shock you. And we're working at this PE ratio by dividing the total market capitalizations by the total earnings of the companies in the share. So, okay, if we look at profitable only companies, what is it? And if we look at all the companies in the index, what is it? Are you ready? Profitable companies, the PE is 17.3, but look, all companies, the PE is 73. So what does this mean? This means that we are looking at a huge distortion of 4 times what the PE ratio is. And that means that there's very, very, very little wiggle room for any negativity. I mean, you're almost at a perfect PE ratio, but yet it's distorted. And the reason why it's distorted is because the 17.6 represents only those companies that are profitable. The 73 price to earnings includes all companies that are in the index. Now, this is important from the point of view that there are ETFs and fund management shares out there, and they you know, to their credit, they openly state that they take the profitable only aspect of the Russell 2000 as a measurement. But when you, for example, iShares Russell 2000 ETF, I'm not commenting on the management of the company. That's up to you to have a look at, etc., like that. But what I'm looking at is what they're basing their PE ratio on. They're basing it on the profitable companies. Well, it's rather like baking a cake without some ingredients in it. You're never going to get the result if you don't have the ingredients for baking the cake. And what I'm actually saying is that if you look at an index, you should really, in my view, look at all the index. And this becomes fairly relevant if we consider that I've just said the S&P is only 5% of the companies in there making up the PE ratio, which are not making money. Now, the S&P 500 PE ratio is 21.3. You tell me which is a more accurate estimation for investment purposes of an S&P 500, where 95% of the shares are profitable, and the P ratio is 21.3, as opposed to the Russell 2000, where only 60 odd percent is profitable, but the 38% drags the P ratio down from 17.3 to 73.6. Would you invest in a company with a P ratio of 73.2? I wouldn't. So this is something that I think you're not getting the full picture. I mean, just to give an example, the average P ratio of the Dow is 20 and the S&P 600, which I think is a better measure for small caps, the S&P 600 is 30. So yeah, I mean, those figures say a lot. Now, it's also important because at the height of the 2000, and this is really, really critical, at the height of the 2008 crisis, the percentage of unprofitable companies was at 45%. And that was when the cost of finance was close to 5%. Now, for most of these companies that are unprofitable, their cost of finance is 2.2% or thereabouts. So when the proverbial crash does come, and it will come, maybe not immediately or very soon, there's obviously a Fed put going on at the moment, when these conditions worsen, many of these companies are going to get crucified, and that's going to make the 45% look like a very small figure. So we can see that mainstream America, looking at the debt, looking at the amount of companies that aren't making money, and looking at the investors that are piling in with what I think are unbelievable P ratios when you look at all the companies, not a very good mix. So this is why you have to basically look at many aspects when you're investing, because what if you're not fully informed of what's going on or what lies behind the scenes, then you're really starting to get into some form of potential trouble when liquidity tightens. Many of these companies, because they're so indebted, are just not going to survive, because their ability to make money, recessions cause companies' income, revenue to decrease. Quite often they cause their costs to go up as well, because they've got to spend more on marketing just to survive. So the variable costs can go up, and of course, obviously, as your expense ratio, as your expenses go up, your ability to pay the debts go down. Now, if you can't maintain your dividends at a previous rate, then investors are going to sell your shares. So what happens is that the shares that are in trouble, as I said, in about the 45%, that was in the worst of the crisis, if those shares, if that number goes up to 50-55%, which is possible because look at the exponential growth, the exponential difference between the net debt and the EBITDA, which I talked before. Remember, earnings before income tax and depreciation has gone up so slowly, that debt has to be repaid. There's just, for these companies to survive, they can't even reinvest in capex. They can't do catch up. They're just going to go to the wall. So you've got to be very, very careful about what you use as indexes. Am I saying that it's a bad investment? No, I'm not saying. I'm just saying you should be very careful, and you should always be very careful about using indexes as a measure for investing in value stocks, because at 17.3, you'd think, compared to the Dow at 20, the S&P at 21.3, and the S&P 600 at 30, you'd think you'd be safe. But are you? And that's the message that I'm giving to you today, and I hope that you've enjoyed this video, and I will see you on the next one. Thank you and bye.